the narrative that you'll hear mostly on the mainstream, news media regarding the stock market is that when interest rates start to fall, that's a good thing for the market, and therefore stocks will continue to rally. I'm not sure that that's necessarily the case. And I put myself in the position of thinking, okay, well, if interest rates start to fall, why are they falling? And I think the motivation for the Fed to cut interest rates really has to be about economic conditions. And to me, that would signal that the economy is not doing well, or the economy is either falling into recession or in an outright recession.
What are the most disruptive technologies in the tech landscape right now, and the investment implications because of these disruptions? We're going to here to welcome back Will Rhind. He is the CEO of GraniteShares. Welcome back, Will. Thank you for coming back, and good to see you as always.
Yeah, good to see you, David. Thanks for having me back on. Always a pleasure.
Before we talk about your ETFs and the tech landscape, let's talk about the markets overall. Interestingly, gold, which is another commodity that you own in terms of an ETF, you have the bar ETF, that has done very well this year, especially in the first half of the year, despite stocks rallying as well during the same time period, despite the Fed funds rate continuously going up, despite inflation coming down. This is a dynamic that we don't always see. Why is it that we saw multiple asset classes rising at the same time that historically don't typically go up at the same time?
Yeah, I think there's maybe a slightly different explanation certainly for gold versus stocks. But with the stocks, I think it's relatively straightforward that the stock market was repriced last year on anticipation. Remember, the stock market's always forward looking. So on the anticipation that rates would start to increase, or what rates would increase, fairly significantly. So that repricing event happened last year. And that's why we saw the big falls in the stock market last year. What's really been happening this year is more being about fundamentals. So in other words, the earnings cycle that came in Q1 and then was followed obviously with the Q2 earnings cycle, for the most part, those were actually very positive and more positive than people expected. So at least the stock market, and particularly the large cap stocks, were in better shape than I think people expected coming into the year. And so those stocks have done well. Specifically in regard to gold, I think the gold is more about a dollar story than anything else. The dollar peaked again last year and has kind of been on a trajectory lower ever since. And really that has helped gold prices not just, increase the first half of the year, but I think maintain a value that is, near its $2,000 type level, which is obviously very high level considering where interest rates are at the moment. So I think, gold has done particularly well because some of the forces that have been holding gold back, namely the dollar, have backed off and allowed gold to appreciate to this level, despite the fact that, again, we have high interest rates.
When the Fed eventually does cut rates, Will, usually, again, gold being inversely correlated to the interest rates, usually that should signal strength for gold. But like we just discussed, this year, gold went up despite higher interest rates. Could gold actually fall when the Fed cuts rates? Is that possible?
Yeah, it's possible. My view is actually, it maybe sounds a little bit contrarian and certainly different from a lot of the mainstream narrative that you hear. But I actually think that gold could do well in that environment. And the reason for that is that I think the narrative that you'll hear mostly on the mainstream news media regarding the stock market is that when interest rates start to fall, that's a good thing for the market, and therefore stocks will continue to rally. I'm not sure that that's necessarily the case. And I put myself in the position of thinking, okay, well, if interest rates start to fall, why are they falling? And I think the motivation for the Fed to cut interest rates really has to be about economic conditions. And to me, that would signal that the economy is not doing well, or the economy is either falling into recession or in an outright recession. So I think in that environment, actually, conversely, stocks don't do well, and gold could actually do well because although gold is sitting at this really nice level at the moment, I think what we've seen continually with gold, throughout history, but particularly, last year, is that people will go into gold when they view the stock market or the bond market, not safe. And that could well happen. Ironically, perhaps, considering some of the narrative out there when interest rates start to fall.
Well, let's turn to stocks now, and in particular tech. Now, the tech stocks have done quite well this year, and in particular the Magnificent Eight. That name's been coined this year. That's dragged up the S&P. It's dragged up the Nasdaq. If you strip out those stocks, though, the Russell 2000 has been flat all year. If you look abroad, for example, in the UK, the FTSE 100 index has been flat, if not slightly down on the year. And so it's really just a few big names pushing up the entire index. Would you say that these names diverging away from the index have been more or less overvalued now or overbought at this point?
I think it's really just going back to the trend that we've seen for the last few years, David. So remember, before the market corrected in 2000 and beginning of 2022, but the back end of 2021, where we reached the high in the major indices. Although at that time you had the large tech companies, the FANG companies, if you will, at that time representing a large part of the market. And for many years before that, people have been saying the same thing, that, the market was being propelled upwards purely by just a handful of very small companies that were gaining an increasing amount of share in terms of market capitalization within the major indices. So I think that is because those companies have, extremely powerful positions. They've got fantastic businesses, huge balance sheets, huge amounts of cash generated, revenue, and are also, in some cases in monopolistic or quasi-monopolistic positions. And so the fact that you could buy those companies effectively on sale last year was a big, motivation for buyers to come in. And perhaps what we're seeing right now is not necessarily the case that these companies are now overvalued or that it's a bubble or anything like that, more just back to the trend that we saw the last few years, where it's just very difficult for incumbents to compete against these very large companies, and they keep demonstrating that through the earnings.
In terms of what technologies are the most disruptive right now, I know maybe AI is on everyone's mind. Is that it, Will?
I think for this year, we have to talk about that. There's just no way around it. I mean, that has been, the major conversation point this year. And again, it was what propelled NVIDIA to its $1 trillion market cap, the highest share price, highest market cap that it ever been. And I think, in that group as well, propelled other chip stocks or other semiconductor stocks higher as well, that people really could now, for the first time, at least as far as ChatGPT was concerned, once people understood that was powered by NVIDIA chips, could really make the link between a company like NVIDIA, or obviously the hardware that they were producing, and a technology such as, the AI and ChatGPT. So, that has been, a huge story, very exciting. Stocks obviously performed incredibly well. And, our ETF, we have a leveraged ETF, 1.5 times levered NVIDIA NVDL, and has been one of the best performing, if not the best performing ETF this year.
Walk us through the logic behind DRUP, the DRUP ETF. You have, yeah.
No, sorry, sorry to cut you off there, David, but no, it's a really exciting new ETF for us. So we launched this, the ticker is DRUP, or disruption. It's a shorthand for disruption, or the disruption ETF. And as the name sounds, what we're really trying to do is capture disruption. And very specifically, this is the top 50 most disruptive companies in the US market as measured by NASDAQ. So it's a NASDAQ index, and obviously NASDAQ have a fantastic brand in the technology space. And this is a new index that they've created that for the first time really goes after disruptive companies and really tries to isolate them. So uses a framework to ultimately compute a score that is around disruption, and then the actual index itself, and therefore the fund, selects the 50 companies with the highest scores, and that gives people a curated piece of disruption, in their portfolio.
How would you define disruption in this case?
Yeah, I think what's interesting is we all know that there are certain factors, and depending on how many sort of official factors you can think of or unofficial ones, but certainly there's no factor when we talk about disruption. And so the idea was really to think about that more as a factor rather than just an ideological concept. And so this particular index try to get to the heart of that by trying to evaluate what are the top disruptive companies. And we know that there are a lot of technology-based ETFs out there. There are a lot of factor-based ETFs, a lot of thematic-based ETFs, but there are no ETFs that actually specifically go after the top disruptive companies and try and find the top disruptive companies that people want to own.
Your top fund holdings as of June 30th. So I know maybe you have an update already, but your top fund holdings: Apple, Microsoft, Alphabet, Nvidia, Tesla, Meta, Visa, United Health Group, Eli Lilly, and Johnson & Johnson. First of all, do we have an update here?
Yep, do have an update. So the great thing about ETFs, David, is that what you're looking at is the quarterly fact sheet, of which gets published, as the name implies, once a quarter. So the great thing about ETFs is they're totally transparent. You can go on our website, GraniteShares.com, look at any of our funds, and you can see the daily holdings that fund owns. So if you look right now, you see the top holding is actually Adobe within the funds. That's in terms of the 50 names that we hold, is the top holding. And then if you look at the sector-wise, the top two sectors that are represented are technology, perhaps understandably, and then healthcare would be the second one.
You don't think that maybe some of the smaller companies or perhaps the private companies, even startups, will be even more disruptive in the sense that they're creating innovations, possibly even on a faster scale than some of the larger blue chip companies?
Yeah, absolutely. What's interesting, David, is that some of the principles around what kind of things that we look for in terms of measuring a disruptive company clearly can be found regardless of whether you're a small company or whether you're a large company. And so those are quantitatively evaluated. And what's interesting is that DRUP is a large cap strategy. So it's looking purely at large cap. But as you probably hinted at just there, it leaves the door open for saying, now that you have a methodology to be able to score companies, then you can apply it to different market caps, different areas of the market. So you can look at disruptive companies in the small cap space, for example.
I'm curious to understand some applications of how AI or use cases of AI in the fund management industry. How is that disrupting your line of work?
It's not disrupting our line of work per se. I think in terms of, first of all, just how we use it as a business. I mean, clearly we're interested in it, but from our perspective, I think it's more what you'll find eventually with AI in the broader market, which is it helps productivity. So, it helps doing jobs, doing tasks, to get things which, previously perhaps took a long time, that you can create vast amounts of efficiencies through that. In terms of the actual, money management process, we don't use it at the moment. It's not to say we wouldn't. I think one of the challenges is that it hasn't really worked for companies or strategies that have tried to do that up until this point. And one of the reasons for that, may be that it's kind of easy potentially to put forward or to get a model that can select stocks. I think the hard part comes that when you have a black box, which is ultimately what an AI-driven model is, when the fund underperforms or when it makes a mistake per se and buys a stock that plummets or buys a stock that falls, it's very difficult to look back and look into that black box and say, why did that happen? What allowed or what decisions were made that allowed this to happen? And how can we correct that? And I think that's really the key challenge with regards to sort of using it for kind of active stock picking.
If someone were to say, well, I'm concerned about a coming recession either later this year or next year or perhaps even the year after, the stock markets have traditionally performed poorly during a recession. Tech stocks in particular are high beta, which means they react more to market movements in either direction. Therefore, this particular fund may suffer during a recession. How would you respond to that?
Well, there's no doubt. I mean, I'm not sure there are many strategies that won't suffer during a recession. There's no sort of silver bullet per se to avoid that. But this is a strategy for longer term investors to buy and hold. It's something that in a diversified portfolio for people that want to own disruption, want to get exposure to those most disruptive companies. It's a way to own that as a curated piece in the portfolio, and obviously own it over time. So unless you're a market timer, that it's a buy and hold strategy, and the market will go up and down. But this is a strategy that you hold for the long term.
Well, I suppose you could just buy the GraniteShares short NVIDIA or short Tesla ETFs as a hedge.
So yeah, exactly.
You've got both ways covered here. That's very smart.
If they're going down, but you never know with what's happening with AI, you might get the opposite reaction. You just never know. It's so difficult.
You got the leveraged long ETFs. Let's talk about some of these single stock ETFs. First of all, why did there's a lot of tech companies you could have chosen for these single stock levered plays. You've got Apple, AMD, Alibaba, Coin, Meta, NVIDIA, Tesla. Now, these are big tech names. Why those ones in particular? And I see you've left out a few other, big tech companies. So clearly you've got a strategy here.
It's a bit more of an art than a science, to be honest with you. But we've been running this business in Europe for a few years, so we have some practical experience in terms of what people like, or perhaps what they favor less. And so we've used some of that knowledge. So I can just tell you that Tesla, for example, one of the most highly traded, highly owned stocks in the world, one of the most popular stocks in the world. So regardless of whether you're an American investor, Canadian investor, whether you're sitting in a European country or an Asian country, Tesla's going to pop up as being one of the top stocks in that particular market. So Tesla's one that we see huge amount of interest in. We have TSLR, which is the highest levered Tesla ETF available in the market. That's 1.75 times Tesla. And then similarly on the short side, TSDD, is the highest leverage short Tesla at 1.5 times short. So Tesla's kind of a phenomenon in of itself in terms of generating interest. But outside Tesla, you have NVIDIA, which is unique in terms of being the only NVIDIA ETF or levered NVIDIA ETF, 1.5 times NVIDIA. And that clearly gives exposure to the AI theme, the short side, the opposite. And then some of our other stocks, we try and pick them where they're going to be unique to the market, but they provide access to things which people don't have access to currently. So the Coinbase one, that's 1.5 times Coinbase, which is CONL or CONL. And when we launched that, there was no way to get leveraged crypto in an ETF. That, as you may know, there's a big fight with the SEC, with the ETF industry about getting a physical Bitcoin ETF. But the only Bitcoin ETF at the time was a futures one that wasn't leveraged. So it's a way for people to play crypto and or Bitcoin, by default or as a proxy using the leveraged Coinbase. Similar with something like Alibaba, that is 1.75 times leveraged BABX as a ticker to Alibaba, a way for people to play Chinese tech as a proxy for Chinese tech market, for leveraged Chinese tech without having to go and buy shares of Chinese stocks directly. That's listed, the ADR is listed on the US exchanges. Meta, again, unique. There's no necessarily a theme as such, but it's a unique product. And so we try and do AMD short. AMDS is the latest one we bought out, one of the latest ones, and provides short exposure to AMD, which is unique. So we just try and think about thoughtfully some of the most popular companies, but where can we add value and where can we provide a solution to investors that doesn't already exist?
Speaking of Chinese tech, this is an interesting development. So earlier in the week, Huawei, which I believe is banned in the US, they released their Mate 60 Pro S, which is a new phone, and in it they used a new chip called the Kirin 9000S. Without getting into too much of the technical details, it's a very advanced microchip with the chip size of 7 nanometers, which is just slightly thicker than the 5 nanometer chips that TSMC uses for their iPhones. Now, Interestingly, now this chip is produced by a company called SMIC, which is a Chinese chip manufacturer. This is an interesting response from the U.S. Department of Commerce just 2 days ago. I'll just read you this Reuters article. The U.S. Commerce Department should end all technology exports to Huawei and China's top semiconductor firm following the discovery of new chips in Huawei phones that may violate trade restrictions, the chair of the House of Representatives said on Wednesday. This is a quote, "This chip likely could not be produced without U.S. technology, and thus SMIC may have violated the Department of Commerce's foreign direct policy rule. The time has come to end all U.S. technology exports to both Huawei and SMIC to make clear any firm that flouts U.S. law and undermines our national security will be cut off from our technology." So they had the trade sanctions in place before to prevent the Chinese from getting this technology. They got it anyway, and now that they did, the U.S. is seemingly ramping up or escalating sanctions. So what's your response to this development?
I think this is, in a way, what was always going to happen when you have these protectionist type policies. And I understand that a lot of these are quite sort of well-meaning in the sense that if you can, stop a competitor, in this case, that's China, the country, from acquiring technology, you can give yourself a strategic advantage. But I'm not necessarily sure that's the right way to go, and that typically the unintended consequences of a lot of these protectionist policies is that what you're doing is you're creating many more competitors because you're forcing that country to acquire this technology on their own and build their own industries that ultimately will compete with the best companies in the world. So rather than saying, okay, you have a free market, and if you're a leader like NVIDIA, for example, and everybody has to come to NVIDIA, and it's much easier for somebody just to buy the chips from them or from best-in-class companies and let them continue to innovate, move market forward. Now you're forcing people to create industries of their own that could end up, not just being competitors, but eking out any technological advantage you had in the first place.
Will these policies impact the way you select certain companies related to chip manufacturing in the DRUP fund or perhaps any other fund that you manage?
Well, yes or no, yes and no. First and foremost, it's just U.S. stocks. It's just U.S. large cap stocks. It's not a global portfolio, so we don't look at companies outside of the U.S. But again, you have to go back to the methodology and to think about what in the methodology that is used in order to score a company high enough to be considered to be a top disruptor. So clearly, if competitive threats or competitive pressures mean that a company is no longer scoring in that way, then like any index, there's a rebalance and a reconstitution whereby that company will be voted off the island, so to speak.
Well, finally, let's move on to a high income strategy that you have, the HIPS ETF, HIPS. Tell us about that strategy. And I want to talk a little about just high income investing as a general theme. But please tell us about this strategy first.
Oh, so HIPS, HIPS, it stands for High Income Pass-Through Securities. And pass-through securities are kind of interesting breed of securities within, again, they're US listed. And they're at some level a hybrid potentially between a fixed income-like security and an equity-like security. So the four main segments of the pass-through security universe are going to be things like REITs, real estate investment trusts, MLPs, master limited partnerships, BDCs, business development companies, and closed-end funds. And what those all have in common is they're non-corporate tax-paying entities. In other words, their earnings or their income that they generate is distributed almost all directly to the shareholders. There's no government or corporate tax agent in the middle that's automatically clipping a percentage of that income. So for the investor or for the holder, you're automatically getting a higher level of income from owning those particular securities. And HIPS is unique because we actually try and target a fixed cash distribution every month that pays a fixed cash distribution, which is a certain amount, 10.75 cents per share per month. So $1.29 of income per annum over the stock price. So what's unique about that is when you buy it, you can actually lock into a certain amount of yield, on that particular day, and that's the amount of income that you've locked into. So it's an interesting product for these times. And despite the fact that interest rates have gone up, the interest rates available on the majority of fixed income funds, indeed equity funds, are still much lower than something you can get from HIPS, which is around the 10% per annum income level. So still like a really interesting product for those interested in income, but particularly that looking for that fixed or that surety around cash distributions every month.
How is the yield generated, Will?
These underlying securities, they're all kind of high income producing entities. So whether it's something in the real estate industry or in master limited partnerships, which typically these are oil and gas or energy infrastructure assets, their sole purpose is just to generate income for the shareholders. And so you're pooling together these income-based assets to create a diversified portfolio of income producers.
Generally, when you're designing any sort of passive income portfolio, whether it be a product like HIPS or just something for yourself, how would you go about deciding which products to own? Because you have a lot of options. You have fixed income products, you have high dividend yielding stocks, blue chip stocks. You have real estate that you could own. You have REITs that generate a yield. You have, going back to real estate, you could rent it out, so on and so forth. So a lot of different things. How would you make that evaluation?
Typically, what we do is, when you start to think about these ideas, it's always useful, I think, and so this is the way we approach it, is to think, what problem do you want to solve that exists today? Or what problem do investors have that you can solve with a new fund, new strategy? And in the case of HIPS, it's a relatively straightforward problem that, although the income or the interest rate environment has changed, when HIPS first launched, and for many, many years, the interest rate environment was incredibly low. So people just couldn't get access to income, let alone meaningful income, and let alone surety of income. In other words, that consistent monthly income. So for somebody who was looking for, say, 5% per annum or higher, there was no real, or there were not no real, but the limited solutions out there in terms of how to get that. And so that was the problem we were trying to solve, problem of how to generate high income and how to generate that on a consistent basis. And so for people that rely on or need a fixed monthly payment, something like HIPS is fairly unique.
Is there? Do you first of all, do you believe the notion that the higher the yield, the higher the risk? And if so, how do you make that balance?
So generally speaking, yes. I'm always a great believer in the phrase, there's no such thing as a free lunch. And so if you're getting something that is a higher yield in this case, then by definition, you're taking on a higher level of risk. But it's always relative to something else, because risk is always relative. So what's the risk you're taking on versus what? And so in this case, at least when we designed the strategy, when we launched, in our mind, yes, you're getting a higher level of yield. So therefore, the portfolio skews more to an equity portfolio. So you're going to have more of the equity-like volatility in there. But in our mind, it was a better proposition than, say, an equity dividend fund, which is very, very popular because it had a similar level of volatility, but much higher level of income. And so that we felt was a trade-off worth making. But yes, it's more risky than, say, treasury bond fund or something like that. But it just depends on always what you compare it to. Risk is always relative.
Well, just on this note, treasuries have, because of the higher yield now, because of the higher Fed funds rate and the 10-year, there's a lot of actually near risk-free products generating a very high yield. How do you, as a fund manager, compete with risk-free that's also higher yield than, let's say, 2 years ago?
Yeah, I think that's a real challenge at the moment for any income producing product. So we're lucky that we produce a higher level of income than clearly treasuries do. But at the same time, a lot of people will look at treasuries and say, I'm quite happy just earning 5%. I don't necessarily need to make anything more than that. And I'm happy to do that in a risk-free or relatively risk-free way. So Absolutely. That's a big challenge for not just us as fund managers, but that's a challenge for the market as a whole. We've seen that with the regional banks, with many other players that have been caught offside, by this, whereby, people are saying, well, why am I depositing, money in a regional bank account and earning zero when I can be depositing it at the Fed and earning 5%? And so that's a real challenge that everybody's facing, not just us as fund managers.
Well, Will, I appreciate your time as always. And where can we learn more about the funds that we talked about?
Best place is our website. That's graniteshares.com. You can find everything on there. But as I always say to you, David, we're a very approachable company. So reach out, any questions, anything you want to learn more, feel free, and we can talk more in detail with anybody. Thank you.
We'll put the contact information. Don't forget to spam Will Rhind's personal inbox. I'm kidding.
I do. I always get people on LinkedIn that say, "Hey, I saw you on David Lynn's show."
Okay.
So there's a lot of people. You've got a lot of fans, David. That watch love what you're doing.
A lot of fans of you, Will. So please spam Will more on LinkedIn, so he'll come back and blame me next time. But anyway, thank you very much, Will, for your time. And
thank you, David. Always great to see you.
Fantastic, and don't forget to check the links down below. And thank you for watching. Don't forget to subscribe and like this video.